cycle. Now, most of these steps you already know how to do from previous chapters. There are some new steps in Chapter 4 which we'll go over. But mostly this chapter is about how you start off every period and end every period with the accounting cycle. So the first 3 steps here, transactions recorded in a journal, post the journals to a ledger, and prepare an unadjusted trial balance. You did all this in Chapter 2. So we had transactions. We used T accounts to post these to a journal. So in real life, we would post these into a ledger and some kind of accounting system. But we're doing that here just with a T account to indicate that we've posted them. And then after we get all our balances from our T accounts, we prepare an adjusted trial balance. So then here's our adjusted trial balance. And the next step is to analyze this trial balance in order to see if we need to make any adjusting entries. So as we're looking here, we've got a few accounts that normally have this one, adjusting entries that need to be made. So what we would do is we would look at these and we would make adjusting entries. So step number 4 and step number 6 are from Chapter 3. So you already know how to do this too. But let's go ahead and do it. So we've got our trial balance here, and here are our 6 different adjusting entries that we need to make, and then we've got some T accounts to keep up with them. So A is the insurance expired during April 300. So when you see the word expired, you could also use the word used. That means used. So let's make a journal entry. If we had insurance that we paid previously and didn't expense it yet, so if we use or expire, that means the next step is to expense. So your debit here is going to be insurance expense. What is your credit? Well, when we paid for this insurance, we put it in this account here for $1,800. And we said over the months that we use it, we will put it in expense. So it's sitting in that debit balance of prepaid insurance. So now that we've used $300 of it, we can take it out of prepaid insurance with a credit. Since prepaid insurance is an asset, it's normally a debit. So decreasing it, you do that with a credit. Okay? Let's post that to a T account down here. So insurance expense will be $300, and prepaid insurance we've reduced. There's your $300 there. There's your $300 there. So we're just posting, we're not posting the expense side, just the balance sheet side here, because they had beginning balances. Okay, so for B, supplies on hand at April 30 were $1,350. Okay, so let's look and see how much is in our supplies account. Our supplies account has $2,200 in it. If it says at the end of the month we had $1,350, that means at the end of the month this balance is supposed to be $1,350. So the difference is what we need to expense. Okay? So when you see on hand, you know that this means that $1,350 means ending balance. You could also see this supplies adjusting entry written like this: supplies used. If you see it say supplies used, they're giving you the in-between number, and then you can arrive at what the ending amount is. So here we have supplies on hand. So our adjusting entry is going to be the difference, which is $8.50. So we will debit supplies expense and credit the balance sheet account that's holding it to take it out of that account, supplies. Depreciation. Depreciation is $3.30. Well, we don't need to make a calculation here. We just need to remember that this journal entry always looks like this. Depreciation expense and accumulated depreciation. Oh, we didn't post our B or C, so let's post B. This is A. B, we're going to just post this $8.50 part. So $8.50 comes out here. And then we don't have a depreciation T account. Okay, so D, we have accrued the receptionist salary on April 30 to be $120. So we need to record a salary that's payable so that we can get the expense on the income statement. So we'll call this salary expense for $120 and salary payable $120. So I'll post that down here. This payable part. We don't have a beginning balance for salary payable, so that's it. And E, rent expired. So I want you to think of expired as used. So now that they have been expired or used, we can expense them. So rent expense, $1,600. And where do we take it out of? So let's go look up here. We have rent when it was paid in advance. We put it in a prepaid account until it was time to expense it. So now we can take $600 out of that debit account. So it's a debit of $4,800. To remove it, we will credit it. And we can post that to our prepaid rent account. $1,600. Last one, unearned fees on April 30 were $2,500. So our current balance is 5, and this is saying it should be, or the ending balance is $2,500. So we're going to go ahead and remove out of this credit balance, so this is a credit, we're going to make it a debit to make it go down. Unearned fees, and our revenue account will use fees earned so that we can show this on the income statement now, this revenue. So we will post the unearned fees. Here. I did that backwards. It's supposed to be here. Unearned fees is there. Fees earned is there. So we've actually posted both of these. So that one's there. And the blue there. Okay, so now that we've posted all of our journal entries to a T account, we've gotten through step number 6, which is prepare adjusting journal entries, and then we've put them in T account so that we can see how they affect the ending balances. So let's rebalance all of our balance sheet accounts here that were affected. Make sure that you can get these same ending balances in your calculator. If you add the debits on the left in your calculator first, subtract the credits on the right, you should get a positive or negative number. If it's positive, it's a debit balance. If it's negative, it's a credit balance. Okay? So once we've got all our new balances in here, we can prepare number 7 on our list, which is prepare adjusted trial balance. So this is part of the optional spreadsheet. So let's go. I kind of skipped step number 5 because normally you would be doing, in real life, we would have probably some accounting software and to be preparing this. But you could also do this in Excel. So in Excel, you could prepare your unadjusted trial balance, which we already did. So this one is the same as this trial balance up here in step 4. So that's your beginning numbers. And then we've changed them a little bit. So this unadjusted numbers include all of your normal transactions that you've posted during the month, but they don't include our adjusting entries yet. So AJEs means adjusting journal entries. So we're going to just list in this column all of our adjusting journal entries from step 6. So the first thing that we did was we adjusted insurance expense and prepaid insurance for $300. So we had this one here, debit to insurance expense, credit to prepaid insurance. So you're going to put a debit to insurance expense and a credit to prepaid insurance. The second entry was supplies. Supplies expense, $850. Supplies, $850. So supplies expense, $850. Credit to the balance sheet account, $850. Okay. Thirdly, we had depreciation expense, $350. And accumulated depreciation, so debit to the expense account, a credit to the accumulated account. Fourthly, we had salary expense, $120, and salary payable. So salary expense, $120, salary payable, $120. Rent expense, $1,600. Prepaid rent, $1,600. So rent expense, prepaid rent, and lastly, unearned fees and fees earned. So unearned fees, we debited for $2,500, and we credited fees earned for $2,500. Okay, so now we've got all 6 of our adjusting entries in here. And so we need to make sure that we balance. So you're going to total up all of your debits, which total up to $5,700. And then you're going to total all of your credits, which total $5,700. So long as your adjusting entries balance, then you should be, and you started off with an unadjusted trial balance that was in balance. See, we started off in balance. We changed it still in balance. So our final adjusted trial balance should still be in balance. So here's a new type of trial balance. So far you've been familiar with the unadjusted trial balance, which just includes our transactions from the month, the regular transactions. Then at the end of the month, we posted those adjusting journal entries like in Chapter 3, which are not normal transactions. We have to manually come up with those and post those. And so now we have a new balance in many of our accounts, so we have to prepare another trial balance we're going to call adjusted trial balance. And then we just basically total up everything. So nothing happened to our cash, so it's going to stay at the same balance of $22,100. Accounts receivable as well, because we didn't make any adjustments to those accounts. Supplies, however, does have a new balance. So we started off with $2,200 debit, and we credited it for $850. So up here in our posting, we ended up with a $1,350 debit balance. So that's what goes in our adjusted trial balance. Prepaid rent started with $4,800 on the debit side, credited $1,600. Here's our prepaid rent account. Should end with $3,200 on the debit side. So that's what we put there. Prepaid insurance should end up at $1,500. We didn't do anything to office equipment, but we did record some depreciation, accumulated depreciation. So that is, I think I put $1,350 and it should be $1,330. So let me fix that. Okay, and up here, yeah, it's $1,330. I goofed. Should be $1,330. Okay. So there. And we'll still, the actual, it does actually total to $5,700. Okay, so our $1,330 here we didn't have a beginning balance. So when we credit that account, that is what's in that account. And then the same with accounts payable. We didn't adjust it, and it had a beginning balance of $800. Salary started off with a zero balance. We credited it for $120, so now that's what's in that account, which is what we had right here, salary payable. Okay, unearned fees. We started off with $5,000. On the credit side, we debited it for $2,500, so we still have $2,500 on the credit side. We didn't do anything to capital or drawing, so I'm going to put those just like they were. And then we have fees earned, went to $23,450, just like here. And then none of our expense accounts, well actually yes, salary expense did have a beginning of $1,500, so we need to make sure to add those together to be $1,620, and then everything else had a zero beginning balance. So then we should be able to add all our debits and all our credits up, and they should balance on both sides. And they do. If you get to this point and you don't balance, then you probably either added the adjusting entry wrong, maybe on either the wrong debit or credit side, or maybe you missed one. So go back and check. Okay, so I'm going to stop here. That's part 1 of Chapter 4 video, and we'll pick back up right here for the second part.